Okay, let's unpack this. We're diving deep into one of the really core documents in the U.S. corporate tax world, IRS Form 1120.
Yeah, the big one.
It's the main tax return for C corporations. And look, if you're dealing with these businesses, or even just curious, understanding this form, it's pretty essential.
That's absolutely right. It's basically the document where a C Corp lays out its entire financial year for the IRS. Our goal here, looking at the materials, isn't just to, list the boxes.
Right.
It's to pull out the key stuff, what this form actually tells you, who specifically has to file it, and the really critical steps and those schedules that give the whole story.
So think of it like getting the essential guide, the shortcut maybe, to understanding 1120,
Hmm.
pulling out maybe some surprising bits and important connections from sources we've got.
Exactly. It's seeing the form not just as like data entry, but as a structured narrative. How the corporation gets from its revenue all the way down to its tax bill.
Okay, let's jump right in then. Fundamentally, what is Form 1120 and, maybe more importantly, who has to use it?
All right. Form 1120, its official title is U.S. Corporation Income Tax Return. Its main job, letting corporations report their income, gains, losses, deductions, credits.
All the financial activity.
Yeah, everything. And ultimately figure out their federal income tax liability.
And the who? The sources seem pretty clear on the types of entities.
They are. Primarily, it's your traditional C corporations. And, that's a crucial difference from S Corp, which have that different tax structure.
Right, the pass-through thing.
Exactly. The sources also mention LLCs, limited liability companies that have specifically elected to be taxed as a C corporation. They'd use Form 1122.
Ah, okay. So an LSC can choose that C Corp tax status. Interesting.
Yep, that flexibility. And it also covers certain foreign corporations, specifically those with income that's effectively connected to a U.S. trade or business.
You mentioned the C versus S Corp distinction. For our listeners who know the basics, remind us of that key tax difference that lands C Corp on 1120.
The absolute core difference, and the material points this out clearly, is how profits are taxed federally. C corporations. They're taxed as a completely separate legal entity from their owners.
Yeah.
That means the corporation pays its own income tax. Its profit or loss doesn't just automatically flow onto the owner's personal tax returns.
Unlike S Corp.
Right. S Corp are generally pass-through entities. The income or loss does typically pass through to the shareholders, showing up on their 1040s. It avoids that corporate level of tax. Form 1120 is literally calculating that separate corporate tax.
Got it. The corporation itself is the taxpayer. So if you're dealing with a C Corp or an LLC tax-like one, this is your form. Now, before even touching Form 1120, the sources really stress getting ready. What needs to be gathered?
Oh, preparation is huge for accuracy. You absolutely need all the financial records for the tax year.
Yeah.
The sources list things like the main accounting ledger, the income statements, and crucially, the balance sheets.
Right.
Specifically, the beginning of year and end of year balance sheets. Those get reported directly onto Schedule L.
Like financial bookends for the year. Makes sense.
Exactly. And having the prior year's tax return handy, always a good idea, just for reference.
What about how they track their money? Accounting methods.
Super fundamental. You have to know which method the corporation uses. Cash or accrual. The sources remind us cash basis means you count income and expenses when cash actually changes hands.
Okay.
Accrual basis means you count them when they're incurred, earned, or owed. Doesn't matter when the cash moves. That choice. It massively impacts the numbers on the 1120 for that year.
Definitely changes the timing. And lastly, the deadline. Don't want to miss that.
Absolutely not. Knowing the specific filing deadline is critical. For most corporations, the ones on a calendar year, it's typically April 15th.
Okay.
If they use a different fiscal year, it's the 15th day of the fourth month after their year ends.
Gather the financials, know the accounting method, check the calendar. Got it. Ready to actually look at the form. Part I, income. How does that flow?
Okay, Part I kicks off with the top line revenue. Line 1A is gross receipts or sales. That's all the money from the company's main business.
The big total before adjustments.
Right. Then right below it, line 2, returns and allowances. That reduces the gross amount for things like customer returns or discounts given.
Which gets you to net sales on line 3.
Exactly. Line 3 is net sales. Simple calculation. Line 1A minus line 2, that's your sort of adjusted gross revenue.
And then you factor in the direct costs of making those sales.
Yep. That's line 4, cost of goods sold, often just called COGS. Now, what's interesting here, as the sources note, is that the detailed COGS math isn't done right here on page 1.
Oh, where is it then?
It's calculated on a separate schedule, Form 1125A. COGS covers the direct cost materials, direct labor, maybe some overhead tied directly to producing the goods or services sold.
Okay, so Form 1125A handles all that inventory and production cost detail. What other kinds of income show up in Part 1?
Yeah, Part I has lines for other income sources too. Things like dividends received, interest income, maybe rent or royalties, capital gains. Dividends, for instance, often get detailed on Schedule C because of some special rules we can talk about.
Okay, so all these income streams add up to.
Line 10, total income. That's the sum of everything in Part 1. It's your starting point before you subtract any business expenses.
All right, total income established. Now comes Part 2, deductions, where companies get to reduce that income. What are some big categories here?
Right. Part 2 is where the costs of doing business get factored in. The sources list a bunch of common ones: salaries and wages, repairs and maintenance, bad debts, rent paid, taxes paid by the corporation, interest expense.
Yeah.
Depreciation is usually a significant one, accounting for asset wear and tear. And that calculation often means attaching Form 4562.
Makes sense. What about things like charitable donations?
Good question. Charitable contributions are deductible, yes, but here's a specific detail from the sources. For corporations, there's a limit.
Okay. Not unlimited.
No. It's capped at 10% of the corporation's taxable income, calculated before you even take this charitable deduction and a few other specific adjustments.
So the deduction depends on how profitable the company was before the donation. That's a really key point.
It really is.
Yeah.
So all these different deductions get totaled up.
And that total hits line 27.
Exactly. Line 27 is total deductions. Now you take that number away from your total income, back on line 10.
And you land on line 28.
Yeah. Line 28. Taxable income before net operating loss deduction and special deductions. This is generally the number that the tax rate gets applied to. Total income minus total deductions.
And that net operating loss, or NOL, that's basically when expenses are more than income for tax purposes in a given year.
That's the gist of it, yeah. You might carry those losses forward or back, depending on the rules at the time. But line 28 is usually your base for calculating the tax.
Okay, base established. Let's go to Part 3. Tax, credits, and payments. How is the actual tax figured out?
Line 30 is where the tax calculation happens, and the sources are clear here. The current corporate tax rate is a flat 21%.
Flat 21%. Wow. Okay. Not like the brackets for individuals.
Nope, just a straight 21% applied to that taxable income figure from line 28. That gives you the corporation's base federal income tax liability for the year.
But they can potentially lower that amount with credits, can't they?
Oh, absolutely. Various tax credits can come into play here. Things like the general business credit, which gets detailed on Form 3800, are applied here to directly reduce the tax calculated on line 30. Credits are powerful because they reduce tax dollar for dollar.
Right, better than a deduction.
Yeah.
And what about payments they've already made? Most large corps pay quarterly, right?
Exactly. Any estimated tax payments the corporation made throughout the year, those quarterly payments you mentioned, which are detailed over on Schedule J, they get subtracted here.
Okay.
And if there was any federal income tax withheld, maybe from certain types of income, that would also be subtracted, though that's less common for regular C Corp operating income.
So you figure the tax, knock off the credits, subtract the payments made, and that leaves you with the final result.
That's line 36, the bottom line. It's either the amount of tax the corporation still owes the IRS, or if their payments and credits were more than the tax calculated, it's the refund they're getting back.
It's a pretty logical flow when you break it down, from
Yeah.
revenue all the way to that final payment or refund. Now, the sources really hammer home the importance of the schedules attached to Form 1120.
Yeah.
These aren't just like optional extras, are they?
Oh, definitely not optional if the situation applies. The main form, page 1, it's really a summary. The schedules. They provide the backup, the detailed calculations, the critical reconciliations. They give the IRS the full story, and frankly, they help ensure accuracy. They are absolutely integral.
Okay, let's hit a few key ones the sources mentioned. Schedule C, what's that about?
Schedule C handles dividends, certain inclusions, and special deductions. It's primarily where corporations report dividend income they receive from other corporations. And critically, it's where they claim the dividends received deduction, the DRD. That's under Internal Revenue Code Section 243. Its whole purpose is to help prevent the same chunk of corporate income getting taxed over and over as it passes between corporations.
Avoiding triple or quadruple taxation. That seems like a pretty big deal in corporate tax, and it lives on Schedule C.
Got it. What about Schedule J?
Schedule J is the tax computation and payment schedule. It basically tracks all the money related to the tax liability. It lists the estimated tax payments made during the year, shows how any overpayment from the prior year might have been applied.
Right.
And it reconciles all those payments against the final tax calculated. Think of it as the corporation's tax payment ledger for the year.
Okay. And Schedule K sounds informational.
It is. Schedule K is titled Other Information. It's mostly a series of yes-no questions and boxes asking for details about the corporation itself. Things like its main business activity code, the accounting method it uses, info about ownership structure, especially if it's closely held. It gives context to the financial numbers. And Schedule L, we touched on this, the balance sheets.
Yep, Schedule L is fundamental. It requires the corporation to report its assets, liabilities, and equity. And it needs these figures for both the beginning of the tax year and the end of the tax year, just like a standard financial balance sheet. This info underpins a lot of other calculations and checks on the return.
Then we get to the M schedules, M1 and M2. The sources seem to indicate these are particularly significant. What's the insight there?
They are absolutely key reconciliation schedules. Schedule M1 is the reconciliation of income or loss per books with income per return. Its job is to explain the differences between the net income the company reports on its financial statements, what you might call book income.
Right, like for shareholders or banks.
Exactly. And the taxable income reported to the IRS on Form 1120, which we figured out earlier. Because accounting rules for financial reporting and tax rules aren't always the same, these two income numbers are often different. Schedule M1 shows why.
So it's literally the bridge explaining why the profit number for the investors might not be the same as the profit number for the IRS. That sounds like something the IRS would look at very closely.
You bet. It highlights things like differences in depreciation methods or certain expenses that might be allowed for book purposes but not for tax, or vice versa. It explains those adjustments.
Okay, so M1 explains the difference in income. What about M2?
Schedule M2 is the analysis of unappropriated retained earnings per books. It takes the retained earnings number from the balance sheet, Schedule L, and basically shows how it changed during the year.
How so?
It starts with the beginning balance, adds the net income per books, importantly, subtracts distributions like dividends paid out, and reconciles to the ending retained earnings balance. It shows what happened to the profits, how much was kept in the business versus distributed.
Okay, so M1, why book and tax income differ. M2, what happened to the book profits kept by the company. Together, yeah, they offer a much deeper view than just the tax calculation. Let's shift to filing mechanics. We mentioned the deadline April 15th usually. What if a company needs more time?
Happens all the time. Form 1120 is complex. Corporations can get an automatic 6-month extension to file the return. They do this by filing Form 7004, Application for Automatic Extension.
6 months is pretty generous.
It is, but here's the critical point the sources make. An extension to file is absolutely not an extension to pay. Any tax the corporation estimates it owes is still due by that original deadline, April 15th for most.
That's a huge distinction. Pay on time, file later if you need to. Okay, how does the form actually get submitted? Can you still mail it in?
You can mail it, yes, but electronic filing using IRS e-file is actually required under certain conditions mentioned in the sources.
Oh, really? When is it mandatory?
A corporation must e-file Form 1120 if its total assets are $10 million or more, and if it files 250 or more returns of any type annually. Think payroll tax returns, info returns, etc.
So bigger, more active corporations basically have no choice. They have to e-file. That makes sense for efficiency, I guess. Finally, you mentioned sometimes there are other attachments needed.
Yeah, these are forms that provide the detailed calculations supporting specific numbers on the main Form 1120. They aren't really optional if you have that item. Common ones we already touched on. Form 4562 for the depreciation math.
Right.
Form 3800 to claim and detail the general business credits. Form 1125A for calculating the cost of goods sold. And sometimes Form 1125E, which is for compensation of officers, if that applies. They're the backup work, the proof for the numbers on the main form.
The substantiation. Got it. Well, this has been quite a journey. Through income, deductions, the tax math, the crucial schedules, filing rules. It feels like we've tracked that dollar from gross sales all the way down to the final tax payment or refund.
We definitely have. And really understanding that flow, knowing what each part, and especially what those key schedules are doing. Schedule L, M1, M2, that's fundamental for anyone needing a solid handle on C Corp taxes. The sources really map it out, even if it's detailed.
Yeah, it makes a form that can look pretty intimidating, feel a lot more, well, manageable when you see the structure and the why behind it.
Absolutely. It's logical, just detailed.
So as we wrap up this deep dive on Form 1120, what's maybe the one key insight or takeaway you want listeners to hold on to?
I think it's that Form 1120 is so much more than just a tax calculation sheet. It's really a mandated financial narrative of a C corporation's year, laid out for the IRS.
Yeah.
While page 1 gives the summary, the real depth, the crucial insights often come from those supporting schedules.
Especially M1 and M2, reconciling book and tax.
Exactly. Those schedules reconcile the company's internal accounting view with the tax view and track what happens to earnings. The sources definitely underscore the importance of getting those right.
Right. They tell a story beyond just the tax number.
And that leads to maybe a final thought to ponder, building on that. Because of the level of accuracy and detail demanded by Form 1120 and its schedules, it ends up being more than just a tax compliance tool. It's actually a fascinating window into a corporation's operations, its accounting choices, and its core financial strategy. You can learn a lot about a company just by understanding its 1120, insights that go well beyond that final tax figure.